Great. Is everything still working?
So for those who just come in, we'll give another 30 seconds. Looks like people still coming in, so let's just wait a little bit longer before we start. Okay, looks like numbers are stabilizing. We might get started. Good evening from Sydney, and welcome to our valuations workshop. This is one of the two workshops that we're doing this week. The first one we did was on report writing, and this one's on valuation and modelling. Before I introduce the speaker for tonight, just for housekeeping, if you have any questions, please submit into the Q&A box underneath your screen, or you can submit that to everybody, or you can feel free to submit it to me directly, which I'll moderate the Q&A at the end. The structure or the format of tonight's session will be 45 minutes presentation, and we'll leave some time for Q&A after. The session will be recorded. It will be made available to the registered attendees. And with that, I'll introduce Lu Yan, who's from KKR. She's currently the principal at the business. I won't say any more because I'll let her introduce herself, because she has an interesting background, and it helps her to put context of where she works and how this fits into the workshop. With that, I'll hand over to Lu Yan. Thank you.
Hi, thanks Frank for that introduction. Good evening, everyone. This is Lu Yan here, and I'll be taking you through the valuation workshop today, which will hopefully arm you with some helpful tips as you prepare for the CFA Research Challenge. Thank you for joining us, and I hope everyone's doing well given the circumstances. So before we start, a quick introduction on me first. As Frank mentioned, I'm a principal at KKR based in Sydney. So KKR is a global investment firm with over US $360 billion of assets under management as of March this year. We manage and invest across multiple alternative asset classes, so private equity, credit, real estate, including infrastructure. I specifically sit within the infrastructure part of the business and am responsible for evaluating, making, and managing investments in unlisted infrastructure on behalf of our clients, primarily looking at investments in Australia, but also with coverage of Asia as well. Funnily, my role is actually quite different from that of a sell-side research analyst, which I understand is the context of the CFA Research Challenge. But of course, there are a lot of similarities and overlap in the technical skills required. So firstly, as a bit of scene setting, to just allow you to put yourself in the shoes of an equity research analyst, what exactly is their role? And the really simple answer is that sell-side research analysts generally have a focus on a set of listed stocks within a particular sector. So they would write opinions on these listed companies that they cover, and as part of that, conduct fairly extensive research on the industry, speak to a lot of people in the industry to help form their views, follow their company's press releases, pour all over their financials, investor day presentations, and of course also maintain a financial model on the company in order to derive a target price for the company shares. And most often that target price also comes with a recommendation around whether to buy, hold, or sell the company shares, depending on where they think value is relative to where the price is trading. And then what happens with that research is that the research is then used by buy-side analysts, fund managers, and investors in general, really, to help them form their own views about a particular company, and as an important input into their own investment decision-making processes. So really, that is your end goal, an opinion piece on whether to invest or not in a company. So with that in mind, I'll get started. In terms of the agenda for the session, I wasn't actually planning to go through Excel modeling itself, as one, I could never cover that in an hour, and two, there's a lot of resources available online already, which I highly encourage you to look for. But what I will mainly focus on is how you should think about and go about a valuation exercise. So to start off with, I'll just kind of get to the next slide. Hopefully that worked. So to start off with, so there are some really key things to remember when forming an opinion on a company. And they're really simple, but sometimes I think you can get so into the detail or so focused on doing a particular task. It's quite important to never lose sight of what your end goal is. And number one, I want to encourage you to always think really critically about a business and what actually makes it tick before you even start trying to undertake evaluation, because evaluation is simply not just a mathematical exercise. And so in order to do that, I would highly encourage you to know the company. So do your research on the company, read the latest investor presentations, annual reports, media releases, etc. But also understand the industry and know the industry, know what the trends are in that industry in which the companies operate, what the competitors are doing, and what the outlook is. And read quite widely about the industry to get different perspectives around where it's heading, to help you develop your own view around where you think the industry might be trending, whether there are any tailwinds or headwinds, and what the growth trajectory looks like. And more importantly, in the context of what is happening in that industry and what might happen, ask yourself, how is this company positioned to perform? Is it a winner or is it a loser? And this will ultimately help you develop your investment thesis along with your valuation. The second point I'd make is that a financial model is really only as good as its inputs. You can have a perfectly structured, formatted, and I guess mathematically accurate financial model, but it won't really make a difference if the inputs are totally wrong. So I suggest in the valuation exercise, I think equal focus, but start with forming an opinion on the inputs. The third point, so there is no one right answer. There is definitely a bit of art to valuation, and although I can say it's still possible to get it horribly wrong, but that's why I think it's quite helpful sometimes to think about a range of possible outcomes and what value looks like under those scenarios, so that it can help you come to a landing on what base case might be. And then the last point, don't overcomplicate it. As I said, there is no one right answer, so don't get too lost in the detail. So the next slide, so I'll touch on this slide fairly quickly. And so listed on the page are a few different ways to value a company. And I'm going to assume that the theory of these have been covered at uni already. So the only points I'd make here is just around the application. So different valuation methods are suited to different types of companies. And so in infrastructure, so for example, Transurban, which I understand is the company here. In infrastructure, we tend to gravitate towards a DCF valuation as the primary method, with a cross-check using relative valuation. And the reason for that, so for example, you wouldn't really use a PE, so a price over earnings multiple to value infrastructure. And the reason for that is because most infrastructure assets by definition tend to be quite asset heavy businesses. And when you're quite asset heavy, you have a lot of depreciation. So your accounting profit is generally not a very good measure of how cash flow generative and therefore how valuable a infrastructure company really is. And that's quite different to say, you know, a tech company which has very little fixed asset base at all. So it would be easier to compare across different tech companies using a PE multiple. The other reason is, so infrastructure companies also sometimes have quite significant capital expenditure programs. So take a greenfield wind farm as an example. And, you know, you wouldn't be able to value a greenfield wind farm on a forward EBITDA multiple. That wouldn't work because in the next year, the wind farm would have no positive earnings. But of course, the wind farm's value isn't zero. So therefore, you have to look at the set of cash flows over a wind farm's entire life and looking beyond the initial construction period of that wind farm in order to get a sense of what the value is over the wind farm's entire operating life. And then obviously you have to discount that back. So in terms of dividend discount models, sometimes this is always, sometimes this is also used in the listed infrastructure space. It generally suits quite stable dividend paying companies. But the trick here is that you do have to form a long-term view of growth. But otherwise, it's still, it's generally quite a helpful reference. And then the last one on the list is LBO, so leveraged buyouts. It's commonly mentioned as a separate valuation methodology, but to be honest, I think of it as not wildly different to just a DCF, but it's rarely used in infrastructure, simply because infrastructure companies tend to already be fairly highly leveraged, just given the stableness of their cash flows. So anyway, like I said, there is no one right answer. So what you often find is that equity research analysts will use multiple ways to value a company in their reports. Moving on to, I guess, the three key ingredients of a discounted cash flow. So just to reiterate, it is the cash flows, the discount rate, and the terminal value. And obviously the cash flows, they're all very important ingredients, but I'll start with the cash flows first. And when modeling cash flows, I think it's always good to have reference to a company's cash flow statement and as a good starting point, so that you don't miss any cash flow items. In forecasting the cash flows component, I would probably always start with the operations. And so start with the revenues. Very simplistically, the revenue for a toll road is basically traffic volume multiplied by price. So it's very similar to a coffee shop. A coffee shop's revenue is the number of coffees sold multiplied by price. And for a toll road, I'm sure it's probably a little bit more complex than that in practice, but very simplistically, that is what it is. And so let us split up those two components for a second and focus on traffic volume first. I do have to be careful not to, I'm told I shouldn't give too many answers away here, but on the page is a list of things that you might want to consider when thinking about forecasting traffic volume. Now, there are varying degrees of relevance for each of these, which you'll need to think about. Try to understand what the relevance and importance of each are. If it's material, focus on it, and if it's not material, move on. As with all valuation exercises, you really do have to take a bit of a 80-20 approach. So just touching on, I guess, a few of the points. So firstly, for a toll road, I mean, you have to know where it is. Think about where it is. Is it a major arterial road, or is it a road to nowhere? What kind of cars travel on it? Is it mainly passenger vehicles, therefore people going to and from work, or are there quite a lot of freight or commercial traffic as well? If it's mainly commercial, think about what drives that. So is it deliveries? Is it increasing online shopping? It could be, a major factory or a major factory or a distribution hub somewhere along the route. And if it's passenger vehicles, think about how does traffic grow with, is it linked to population, for example? Does population growth necessarily mean more cars on the road, or is it something less? And then the other point, are there limitations to growth? So, for example, if your toll road has 2 lanes, it's hard to see how a toll road's traffic can grow by 20% a year for 10 years, because it will soon become so congested that no one will want to use it. And things like, of course, then there on the other end of the spectrum, there are things like growth plans of the company. So, maybe you're adding like another few kilometers to the toll road, or you're making the toll road from 2 lanes to 4 lanes. So all of those things will impact traffic, and you'll have to think about how they might impact traffic. There's also, of course, things like public transport. I mean, and public transport also feeds into, I guess, a competing mode or alternative mode of transport. If right next to your toll road, you have a new train line coming in, that's obviously going to cannibalize your future traffic growth. So one that's not on this list, there's of course COVID. In the airport space, for example, there's been a lot of debate around what the impacts of COVID are on long-term travel patterns. So for example, all the businesses these days have been doing their meetings by Zoom. And the question is, does it change people's work habits in that they feel like they don't need to travel for business anymore? That's an open question. And similarly, if we extend that to a toll road, everyone is sort of doing hybrid work from home arrangements. How does that change in the future? And therefore, how does that impact traffic on the roads. And then going to, I guess, the price side. So you obviously have your tolls. I think the only thing I'd encourage you to consider there is whether there are any restrictions around price increases. So just think about the potential public outrage if, for example, tolls increased by 20% a year. So I think that's definitely something to keep in mind and do a little bit of research on. Then you have, I guess, just to help work down to EBITDA. Then you have, all your costs which you can, which you should consider, and in thinking about that, of course, having a look at the company's historical margins. And very importantly, always substantiate your assumptions and provide reasoning for why you have made particular assumptions and the rationale. Sometimes to demonstrate the critical thinking that you have applied to come up with those assumptions are just as important as those assumptions themselves. Because the reality is no one has a crystal ball, and you're never going to get the forecast 100% correct all the time. If you do, I suggest you buy a lotto ticket. But I think, which is why it's very important that you set out that logical thinking on how you've derived your assumptions, and then therefore when things change, as they always do, you can dissect that and connect the dots on with your model. That being said, please don't write 20 pages on it. People are quite short on time these days, so you'll be much more impactful if you can synthesize all of that down to very, very key digestible data points. Moving down to, I guess, the other quite fairly important cash flow items, and that is capital expenditure. Like I said, infrastructure companies tend to sometimes have quite significant ongoing or growth spend. There's of course ongoing maintenance works, but then there is also growth capex. So for new acquisitions or road extensions, etc., it's important to factor that into your cash flows, because it's important from a near-term cash flow perspective, as well as the potential impact on future revenues. And then there is capital structure. And so I suppose I didn't quite mention this at the start, but you do have to make a choice on whether you are approaching valuation as a free cash flow to firm or free cash flows to equity. And depending on what you choose to do, and again, there is no right answer to this, but depending on what you do, capital structure may or may not be relevant. But really, if you think about cash flows to equity, of course, you'll have to consider, if there are, what the debt funding profile looks like and what the interest costs are in your future forecast period. Okay, so moving on, I guess the next two ingredients of a DCF is obviously the discount rate and terminal value. With discount rates, I think you guys would have all learnt about CAPM. That's certainly a very good starting point, but discount rate is also a proxy of risk. So high discount rate equals high risk. Usually that could be captured in beta if you use the right comparable companies, but the beta, as you know, looks at the industry in general. So you do have to think about whether there are any particular set of risks within those cash flows, and whether you have appropriately considered that risk within your discount rate. And then finally, there is terminal value. And so TV's terminal value is quite important, because unless you plan on forecasting cash flows for the next 100 years, which please don't, you will need a terminal value, because the company just doesn't, suddenly stop generating value at the end of your forecast period. So when you typically look at terminal value, it actually is generally a very big proportion of your total value. So it's pretty key to underpinning your valuation. So you do have to decide how long to model for. And to be honest, it's really, really hard to forecast out beyond 10 years, especially if you're only forecasting out based on public info. So I would suggest you limit that. I think generally in the equity research space, people look at a no more than 10-year period, but it could range anywhere between 5 to 10 years. Just, I guess, for reference, in the unlisted infrastructure space, we generally would model cash flows out for at least 20 years and sometimes 50 years or more. But the reason for that, which is distinct to an equity research analyst, is that we generally have quite a lot of expert input into our long-term cash flows. We would always commission support from, say, like an engineering company or another expert consultancy to help provide input into what those longer term drivers might look like. But obviously in the equity research context, that's generally not applicable. So I guess there are two approaches. Either an exit value exit multiple or a terminal value growth method. So exit multiples are intrinsically linked to growth. So for example, if you bought a company at a 20 times EV/EBITDA multiple at a time of significant forecast growth, and then growth slows down by the end of year 10 because it's sort of just gone through a period of growth cycle driven by sort of one-off events, then by the time you get to year 10, if you were thinking about your terminal value, you can't exactly apply the same multiple as what you entered into because the growth profile has completely changed. So that's just something to think about as well. I'm just doing a bit of a time check. I'll move quickly to some modeling ground rules just to cover off on the DCF section. So this is not an exhaustive list, but they're quite important rules to try and stick to. By the way, I think people can have very, very different preferences in their setup of models, and there can be quite a wide spectrum of model complexity depending on what the purpose of that model is. So on one end, some are really, really complex models with macros that are automatically solving your debt profiles, quarterly cash flows for 50 years. You can have sheets with over 1,000 rows and a model that can run, 100 scenarios. On the other end of the spectrum, you can have a model that is simply one sheet in Excel as well. Now, as an equity research analyst, I suggest somewhere in between, but probably closer to the simpler end. And I believe most equity research analysts will try to do their model quite simplistically in maybe 5 or 10 sheets. But it's all about finding that balance. But anyway, I think these rules, despite sort of different personal preferences amongst different people, I think these ground rules are pretty commonly accepted across the board. And the first one is on structure. So their structure is really important. So there are generally 3 types of sheets, being inputs, then there are calculations, and then there are outputs. and your inputs are going to be most likely hard-coded assumptions. So for example, your CPI forecast or the latest, set of financials or an actual historical traffic number. It's pretty important that whenever you are hard-coding an input, you only ever hard-code it once. So don't hard-code, $100 in one section of the sheet and then hard code it again in the next section of the sheet, and then in a different sheet hard code it a third time. It becomes quite inefficient and it exposes yourself to more mistakes, because if you find that you want to change that assumption, you have to go change it in 3 different places, and more likely than not, you might forget where else you had input that assumption. So there's a very good logic as to why you should only ever hard code an input once, and everything else you can just link it to that input. And then you have the calculation sheet. So that's all your operational forecasts. So all the traffic tolls and OPEX forecasts suggests having it in a operational sheet, and that really gets you all the way down to EBITDA. And you could also include CapEx in here. And then a lot of people also like having a separate financing tab, but obviously if you're doing free cash flows to firm, that's not as relevant. And then there's color coding. This probably seems like very simple and maybe unnecessary, but I think color coding is really important to help the user understand what the different types of data is working in the model. So whether it's a hard code input, or whether it's a formula, or whether it's a link to another sheet. And it's just very easy and user-friendly for you to then organize that in your mind when you're working through the model. The next one is labeling everything correctly and consistently. And so the one example that I would call on here is that, so if you labeled one input as a real dollar input, and then you forget about it and you label it as a nominal dollar input in another sheet, and then forecast that out going forward, you would have obviously then totally underestimated that particular forecast, because it's actually meant to be in, you actually needed to escalate that going forward, but it's in, but then it becomes constantly in real terms because you forgot about it when you labeled it incorrectly. And then the other one is, the final one is just consistency across columns and rows. So for example, if you have the year 2021 starting in column F in one sheet, have it start in column F in another sheet. And the reason for that is you wouldn't want to accidentally link when you're pulling outputs, when you're pulling data from one sheet to another, you wouldn't want to accidentally pull from 2020 when it's meant to be 2021. So having it in the same column will ensure that you have that really quick sense check, that the model integrity is there, or one of the checks to make sure your model integrity is there. The next one, I'll just talk a little bit, and finally, I'll just talk a little bit about relative valuation. So on the page, I've got some examples which I'm sure you were seen and covered at uni. So I might just skip to just an example and to demonstrate how important comparability is when using relative valuation. And in this instance, I wanted to use Sydney Airport as an example. So I'm going to pretend COVID never happened, because obviously COVID's had a very big impact on the numbers. So let's take us to pre-COVID times. Sydney Airport traded at a 19 times EV, a 20 times EV to EBITDA multiple pre-COVID. And then you have 2 other airports, ADP, which owns Charles de Gaulle Airport in Paris. That airport traded at 11 times EV to EBITDA. And then you have Auckland Airport, which trades at 17 times. So, oh, sorry, not 17. That traded at 24 times, sorry. So they're all airports, but they trade so differently. So in order to understand why, you really have to know what the key factors are that makes them different. Because say, for example, if you did happen to be doing a valuation for Sydney Airport in this instance, you wouldn't be able to apply an 11 times multiple to Sydney Airport, because arguably you would be saying that basically it is worth much less than what it is trading at now. And that probably wouldn't be the right conclusion. And so, then in order to understand what the differences are, there are a few, I guess, key things to look at without having to do research on all the companies. So the first thing to check is, what are the margins? So ADP had 40% margins and Sydney Airport has around 80% margins, meaning that Sydney Airport is actually much more profitable than ADP. So that's one particular data point. And then the other data point that you can look at is what dividend yield is. So pre-COVID, Sydney had a 5% dividend yield, meaning that it is actually quite cash flow, it's very cash flow generative, because when you compare it to ADP, that actually traded at a 2.2% dividend yield, meaning that ADP was not as cash flow generative, I suppose. It wasn't distributing as much cash out to its shareholders relative to Sydney Airport. And that probably explains some of that difference in that, that multiple. Oh, on top of having completely different regulatory environments, of course, which is a key determinant of key factor in revenues as well. And then you have Auckland Airport, which traded at 24 times. Now, arguably, this is quite, this is not as intuitive, because you would have thought that Sydney Airport, being a more premium, arguably more premium hub than Auckland Airport, you would have thought Sydney Airport would have traded higher. But when you look into Auckland Airport, you can find that, you know, maybe they had a very, very big CapEx program or a growth program in place that may have impacted, or that may have contributed to that higher EV/EBITDA multiple. And then finally, the other one that people generally have reference to when looking at relative valuation are transaction comps. I think in equity research, it is fairly uncommon to use transaction comps to value a company. And the reason for that is transaction comps generally, so for example, if you have a takeover of a publicly listed company, there is generally a control premium paid. So ordinarily, without a transaction or a change of control M&A event, a company's trading price in the ordinary course of business would never be valued at that same, with the same control premium in place. And therefore, when you set your target price for a listed company, you generally wouldn't assume that there is a takeover offer coming. And therefore, transaction comps are generally not used, but they can still be fairly helpful references. So I think I sped through that quite quickly. I'm doing very well for time, Frank. So I think we can open it up to questions.
That's great. No, thank you, Luyan. We're very fortunate to have Luyan to present to us today, because that's very well explained. I hope you guys all got something out of it. So we'll jump into Q&A. I might kick off with one, if I may. When a listed infra manager looks at a stock versus an unlisted infra manager like yourself look at it, Is there any differences in the way you value a company? If so, what are the key differences?
I think, to be honest, I've never worked in it as a listed in the listed context before, so I'm not 100% sure how they might look at it differently. And I think it depends if they're like an active or an index sort of following fund manager. But for in the unlisted space, we generally take a really long-term view on infrastructure valuations, and which is why in unlisted infrastructure, we sometimes, would model out for 50 years. Whereas in the equity research space, it can be sometimes very, they can be very short-term horizons because there is so much liquidity in the listed space that you can always enter and exit. And so that's what I find the key difference would be, I think.
Sure. And so one of the things you mentioned was around the control premium. And when you're taking over a listed company, how do you, because one of the questions here is about how do you factor in a minority stake and so on the other side is the control premium. How do you consider that when you're valuing a company?
Yeah, I think in the listed space, I generally think of all the valuations in the listed space to not have any control premiums. They're generally minority stakes, right? So when you buy a company, you could buy like 1,000 shares and still own very, very little of the company. And the key thing here is that you don't actually control the company. You can't change the company's destiny. You have no say around the company's strategy. It requires quite a lot of, you do need to have a significant interest in order to be able to influence that. And that's why when there are takeovers, there's generally a control premium paid because there's an argument that you will fully control the company, and therefore you control the business plan and where the company focuses its attention on around growth and future opportunities, etc.
Yep. And given these are very long data models, and as you say, some goes 50 years. So the question here is around how do you value these companies in the terminal period of a DCF, so the later years, but also maybe just share some thoughts on how do you come up with the terminal value or considerations you need to have?
Yeah, there are rules of thumbs, I suppose, in the industry. But I think when thinking of terminal value, it's probably especially if you're sort of say forecasting out 50 years, it's probably most important to look at what the terminal value growth rate is. And so like if you're modeling 50 years, like it's going to be very, very difficult to put up a really good argument that terminal value growth can be 5%. Just having regard to where long-term CPI is, where GDP is, where population growth is, that would be very difficult. So I would assume that for an infrastructure company, it would generally be that your cross checks for your terminal value growth would be somewhere between your CPI and your real growth forecast.
So a question around those macro assumptions, as you mentioned, forecasting them, whether it's short term or long term, is very difficult. How do you, where do you source them from, and do you overlay your own judgment on them?
I think the key thing here as an investor, as an equity research analyst, is that you don't have to have the answers to everything, but you just need to know how to get those answers. So I cannot profess to be a macroeconomic expert. And so I would not really try to forecast out macroeconomic assumptions. So for things like population growth. And the reason for that is that there are a lot of other people who already do that for you, who look at, immigration, births, deaths, etc., and they forecast out that long term. And, you know, the easiest source there is ABS. They're public. For things like CPI, obviously one data point is that our central bank have a target of between 2 to 3%. So you would have thought that policy will ensure that, you know, over the long term, on average, CPI will sit somewhere between 2 to 3%. And things like GDP, again, there are a lot of forecasters out there, and you don't have to, and there could be like a lot of different views, but you can read about it and think, read the various opinions and form your own opinion on, you know, where that might land, or who has the strongest argument for why GDP growth should be X%.
Yeah, no, they're very valid points. Now, when it comes to management guidance, how much weight do you put on them?
I would say in the near term, the reality is that management tend to have the clearest line of sight on where they're heading, and public companies are quite they're quite good at that as well. Like, there is an expectation and there's a lot of pressure on the management team on providing good, clear near-term guidance and forecasts. And so, especially in current financial years, unless you know, from speaking to people in industry, you think, oh, you know, this is a really bullish forecast that management are having, I would lean towards, you know, thinking about including management's forecasts, at least for the near term.
Okay. For a company where they have a number of underlying assets in different regions, if you want to value each sum of the parts, should you be coming up with a different WACC for each of the underlying?
It's a good question, but I think at the end of the day, you are buying a whole company, which I suppose is a value of its sum of the parts. I think in doing that, I would probably have reference to how big that international component is. And so if it is a material component of the business, I would probably look to split that out and think about a WACC for that particular business. But if it's not, I probably would just group it all together. But it depends on materiality, of course.
Yeah. I think this question's being answered, but just want to see if anything else you want to add. When using DCF, would it be appropriate? What's appropriate forecast period? 5 years, 10 years, or longer? But I think you sort of mentioned you can go up to 50 years, really, if you want to.
Yeah, I think in a listed context, it's really hard to forecast out beyond 10 years because it's hard to see, you know, without specific expert input or commissioning a specific piece of work. I think it's really difficult to forecast out beyond 10 years. And the general approach by equity research analysts is that you would take a 5 to 10 year period and then apply a terminal growth. And the reason for that is, you know, by forecasting it out yourself, you may not come up with a different outcome versus just applying a terminal value growth. Because beyond 10 years, if you were actually doing it in practice, like, you might just like gravitate towards escalating something by CPI or maybe CPI plus a little bit of real growth, but you would get to the same answer by applying a terminal value growth method.
Right. Is it different when the asset itself has very stable cash flows, like a toll road?
Yeah. Yeah, I think so. So, I mean, unless you have very good visibility that, you know, in 10 years' time, there's going to be a new toll road that this business is going to acquire, and therefore it's going to grow. Like, I think it'll be pretty difficult to form that opinion unless you have quite deep expert knowledge around, say, for example, the longer term road toll road network development or master planning of Sydney. So I think there's generally very good visibility on near term, but in the future period, it's going to be very difficult. And also you have to think about, you're setting a target price for now. By including in your valuation something that might not be real, it is very difficult to then say you should pay for this company X dollars when you have included in your forecast a major acquisition that you have not even identified in 10 years time. So I think it does make it fairly difficult.
Yeah.
And you would obviously be, discounting that at a much higher discount rate because of the uncertainty and risk associated with that. So I think I would definitely suggest keeping it to 5 or 10 years, and not including sort of, unless you have visibility, not including any major growth projects.
Yeah, makes sense. When it comes to qualitative factors, so the question here around management experience, ownership, but also another question like ESG. How do you factor those factors into your valuation model?
I'll take an ESG. So this is obviously a very, very big topic for companies all around the world. And I think at the moment, it's been a key challenge to actually quantify what ESG means for a company. And there are a lot of qualitative factors around ESG and how well it's managed at the company. But I almost think of it as you do have to think about the ESG risks for that specific company. Obviously, for a coal mine, the ESG risks are completely different for a toll road, like Transurban. So you generally need to consider what are the key ESG risks, and if they are positive or negative, what is the materiality of that to the company's valuation? If it's really, really material, then you should consider quantifying it. But that being said, I think it is very, very difficult at the moment, and there is no standardized way to quantify an ESG risk. So a lot of people generally think about it from a qualitative perspective. And again, it goes into the overarching story of your investment thesis for the company. So that was ESG, and the other one was management.
Mm-hmm.
I think the management, the quality of the management team is not a direct, I guess it's not, you don't sort of scale, you don't necessarily, there's not like a formula to scale up and down your cash flows depending on the quality of the management team. I think it really goes to, is the management team able to deliver? So for example, if you've got a publicly announced capital expenditure program of $1 billion, if you think that the management team is terrible, then the risk of that capital program going over budget is probably higher relative to a really solid, strong management team. So I guess I don't have a good direct answer to that, but it is a factor you should think about when thinking about particularly growth projects, but growth projects like operational costs. So like managing cost outs, cost efficiencies, the more experienced and capable the management team, the better they will be able to continue to improve on cost efficiencies. And therefore you can think about, over time, do costs escalate less because the management team are just better at their jobs.
Yeah. And I guess what I'm hearing is there are some that are baked into the base case, but I think some of these quality factors is more of an opportunity for students to put in scenario analysis or stress testing the base case.
Yeah, probably, yeah.
When it comes to an environment we have today where there's just so much uncertainty near term, vaccine rollout, Delta variant, how do you consider that in your valuation models?
I think the answer is no one has a crystal ball. So I would suggest running different scenarios. So what does the company's value look like if we're in this situation for another 3 years, which is a bit extreme. I should probably say maybe 1 year, maybe 1 year. And then what does the company look like, if we're out of COVID immediately? I think the reality is though, when you're looking at a valuation or a DCF over a 5 to 10 year period and applying a terminal value, the first year I think is important, but again, a terminal value in year 5 or 10 is actually I think usually more than 50% of your total value. So I think it's important, but it might, a lot of people might include that forecast, make an assumption around when we're going to normalize. And you could have regard to things like vaccination target rates, and just make an assumption of this is the base case. And then you can make an assumption around what it looks like if we don't meet our vaccination targets, and have it as a downside scenario.
Yeah. Yep. We've got a few minutes left. We've still quite a few questions here. I might just pick 2 more. I'll read this one out. I'm not 100% sure what this means, but I'll read it out. Since CAPM captures the cost of equity for capital gains, should we also couple this with the DDM for dividend distributions so that it shows a true whole value of the cost of the equity?
I'm actually not quite sure what that means, as I've never coupled a cost of equity with a dividend discount model. So if you think about it, capital gains is, so a value of a company is kind of like a value of its distributions plus a value of capital growth. And when you're doing a discounted cash flow analysis, you are effectively valuing both those things, because when you're doing you're effectively valuing all of those things. It's the value of cash flows as well as capital growth. So yeah, I must admit, I'm not quite sure how to answer that question.
Oh, good. And final question. Not all companies are like infrastructure assets that deliver stable, visible cash flows. So for companies that deliver negative earnings, how do you value those companies?
I think it's not a problem I've had in the infrastructure world, because we generally look at very cash flow positive assets and businesses. I mean, like by definition, if the company is currently not generating positive earnings, there has to be at one point where it starts generating positive earnings. And so like, I think in your modeling or your valuations, there has to be that inflection point where the growth and the revenues are greater than the cost base. Otherwise, if a company is forever making losses, I think it's definitely quite hard. So you have to see through the temporary losses and look through to where that future growth is.
Great. Okay, I think time's up. It's been 1 hour. So I just want to firstly say thank you, Luyan. That's been really good. Really appreciate your time, and I hope all the students got insights from today's session. And to all the participants who are still here listening, thank you for your time, and we wish you all the luck in this year's research challenge. We'll see you either at the grading set period or at the finals. We'll see you then. Thanks again.
Okay, great. Thanks, everyone. Thank you. Bye.